Okay, thanks for joining, everyone. Let's kick off the session. I'll start doing this for 5 to 10 minutes update, and then we go to the Slido. I think this week we have more questions to go to address. Okay, so let's start. So if we look at the market over the past week, I think we are back to around June low, right? So just over the week, the market S&P 500 is down by 2.6%. And then for QQQ, it's down by 2.8%. So this one, I don't consider this as a very big drop. But then if you consider how much it's dropped from the June low, right, I think we are close to 52 weeks low. In fact, there are quite a number of companies that in my watch list, right, is already hitting 52 weeks low. So I think that's why the sentiment is also quite bad now. I think this one will provide, just before I go into the details, right, I will share a couple of slides from JP Morgan Asset Management. I think they have quite a nice compilations of different economic data that I think is quite useful. And I think they publish this on a quarterly basis. So we just have the September 30th, 2022 numbers here, right? So this is not the full deck. Later I will share in the group chat on the full deck. You can take a look. These are some of the decks that I think is quite interesting. So we'll just take a couple of minutes to walk through the details. So the first one, right, this is showing the S&P 500 index at inflection points. So it's just to show that, in 2000, around dot-com bubbles, you can see this is the figures, right? So it can go down by 49%. This is the drawdown that we experience. And then there's a market rally from the bottom of this crisis to the height just before the global financial crisis, right? So it went up like 101%, and then it crashed 57% here. Then this is the big bull run, right? From 2008 until just before COVID crisis, it went up by 400%, and then it crashed by 1/3 or 34% during COVID crisis. Then we have the steepest rally because of the Fed quantitative easings, right? This is the QE4 already, and market went up by 114%. And recently, we are seeing that the S&P 500 is already dropped by 25%. So 20% drop, that's bear market. So we are now confirmed in bear market already, and just don't know how long it will last and don't know how low it will go, right? So I think this is a good chart now. Then the second one, actually this one, the first one, they're showing all the forward PE. I think this is quite useful also, just to show that what is the current valuations, right? For example, if we look at the forward PE now is at 15.1, right? This is not too different compared to the forward PE as of March 2020, which is the COVID low, which is 13.3, right? So it is not about the same already, like similar level. But this one, if you want to say that the valuation level is about the same, it also you need to judge whether the earnings does it make sense or not, because earnings, current period earnings is quite high because of all the recovery during post-COVID. So you can look at this. I think this slide is showing the forward PE. Now we are, you see, from the high of about 22x, now we are back to 15x already. It's considered not so expensive if we believe that the earnings will able to keep up. But let's say if the earnings just drop by 20-30%, right, then you will see that actually the PE or the forward PE level is not at this level, whereas it should be a lot higher, right? So the market is expensive if you think that the earnings will drop. I think this is something to watch out for. But overall speaking, if you don't just treat the earnings or the forward earnings here, right? Just treat the forward earnings as something that is representative of the market, and you are not seeing a huge drop in the earnings, right? I think current level is a level that we can say is not excessive now, but it's also not cheap, because you can see that if we have a big crisis, right, forward earnings can, or of the forward PE can drop to level around 10x, 10 to 12x. So this has happened in the past. Then the next one, okay, this one is talking about the corporate profits. But I just think that this is quite interesting, because if you, actually the current period, this is where we are, the dark bar here, the black bars here. But if you look at the consensus analyst estimates, right, as of now, as analysts still haven't projected that the earnings will come down. If you look at the consensus, meaning that I think they just look at the average, right? It's still projecting increase earnings over the upcoming few quarters. So you see the blue bar is still up, right? But there's a lot of signs that pointing towards that the earnings that we have seen so far, right? This might be the peak already. We were likely to see a drop in earnings in the future. So this is one thing to take note. And if you look at this small box here, right, I think year-to-date basis, you see year-to-date market has already dropped by about 25%, right? But if you look at earnings, actually earnings is up about 5% during this period. So what it means is that the earnings has increased by 5%, but the multiple growth rate is already dropped by 30%. So you sum these two up, overall market has dropped by 25%. So this one, just to the picture, right, or the what we can learn from this is that actually the drop, right, is all just the multiple or the PE, right, the forward PE multiples. The earning itself hasn't dropped yet. But if you look at in the past, right, whenever we have a so-called crisis, right, the earnings will actually contract. So that's why the green bar here is showing the earnings recession. So you see it happened after the dot-com crisis, and it also happened during the global financial crisis. And also there are like 1 or 2 quarters of earning recession around year 2015 and also during COVID. So you can see that it happened in the past. So let's say if we take this earning per share of about 200, let's say 210 here, right? I'll say that if we hit by earning recessions, it's very possible that EPS, right, earning per share can drop to 150 or even lower, right? So this is definitely possible. If this happen and then you combine it with another, market always overreact, right? And then multiple may contract further, and that's where a huge drop may happen. So this one just to address one of the questions asked later about do I think that all this big financial crisis will happen or not. So you still have to look at the underlyings, right? The fundamentals, which is the earnings. Then the next slide, this is also something that I find quite interesting. This one, they're saying that, okay, the red dot, right? The red dot that you're seeing, this is the intra-year drop. So they call it the annual returns. The annual returns is the black bar. And the intra-year declines, right? This is the decline that we see within the year. So for example, right, in year 2020, right, you remember from February high to March low, right? The market actually dropped by 34%. And then subsequently, market just climbed up and up and up and it recovered, right? And by the end of the year, right, meaning if we look at January 1st to December 31st of December, actually market is positive. So they recorded around 16% gain. And then 2021, another 27% gain. But actually, if you look at the intra-year, there are huge drop, right? But for this year, because I think the market high is very close to the beginning of the year, right? So the intra-year drop is about 25% and the year-to-date drop is also 25%. So I think what they try to say here, right, is that despite average intra-year drop of 14%, right? So if you just look at the average of all these red dot, right? Within the year, the average maximum drop is about 14%. But if you look at overall basis, right, 32 out of 42 years, right, this is about what, three quarter of the years, you still end up with a positive returns. So I think this is very interesting. Although if you focus on the short term, just within the years, this is talking about like those who only invest for a year, right? So within each calendar year, you can see that market can drop by average of 14%, which is not a small drop, but it tend to end up with a positive returns because I think there are years that they drop first. You see like 19% drop here, and then it recover within the year, right? So I think this is quite interesting to look at now. Then I think this is the second last already. So this one is just to show the market inflection points, showing the past recession, right? So you see March 2020, this is a recession. And then prior to that, global financial crisis, this is also recession, .com. And then these are those that is even, in the early periods. But when we talk about recessions, right, one thing to note for is that usually the unemployment rate will be very high. you see the purple lines, right? So you can see that they tend to go up. You see the gray area, this is the recession. So after the recession or during the recession, you see that the unemployment rate will shoot up. People are losing their jobs, right? So you can see that here it shoot up to 6%. This one shoot up to about 7 to 8%. This one about 7%-ish. This one also you see as high as 11% or between 8 to 11%. So you can see that if there's a big crisis, right, what we most concerned of is actually the unemployment, because when the unemployment rate just keep on shooting up, right, people are losing their jobs. They don't have money to spend. If they don't have money to spend, means that corporate can't earn monies, and then the earnings will drop, and then the sentiment will be very bad, and stock market will be affected. So you can see, pay attention to the purple lines. Then the question is currently, right? Where are we now, right? So if you look at the unemployment rate, it shoot up during COVID crisis, right? So as high as 14%. Then after that, we have a strong recovery since COVID March 2020 until now, right? So right now we are at 3.7%. There's a little bit of increase here, but we're still early, right? So say, for example, now we are really heading into a recession for next year, right? So we don't know like whether this one could be like go up to 4%, 5%, or even 10%. This one we really don't know. But there's already some sign pointing towards that the unemployment rate will go up, right? And Fed Chairman Jerome Powell, he also said that the unemployment rate will increase. And this is a pain that we all just have to endure so that the inflation will come down. Because if the unemployment rate is continue to stay low at 3.7%, and everyone, like most people who want a job will have a job, right? So as long as they still have the money, they will just spend and spend and spend. And very hard to bring down the inflation stuff. And if the inflation is high, they have all sorts of negative impact. So this is just something to note for, because I think that many people, when we talk about recession, they always talk about like GDP, all these things, right? I think GDP is slightly lower. I think this is still fine. But the unemployment rate is the one that is very hard to address. I think that's on the unemployment. This one also quite interesting. And to be frank, this one is not something that I pay a lot of attention to. This is the consumer finances. So I think the most interesting part is the part that's showing the excess personal saving relative to pre-pandemic trends. So you see, this is the COVID period, right? Right after COVID, there's the bar here is above zero, right? What it means is there's cumulative excess savings here. So this bar here is actually showing the disposable personal income, less consumer outlays. I think what it means is that they just look at on aggregate basis, are people's earn, what's the amount that they earn, so their income, right, versus how much is their expenditures, right, or how much they spend, right? So this one I still need to look up the exact definitions. My definition, the one that I just described, might not be 100% accurate, but I think this is the simple way to look at it, is that this is how much savings, so excess savings, right? So it's positive throughout until somewhere around late 2021, and you can see that actually the saving, right, is already less than the consumer outlays. So there's already a saving drawdown within this period, and it seems that this drawdown is getting higher and higher. So I think this one is quite worrying, because imagine that if everyone just earn more than they spend, right? So all this excess saving, it will flow to somewhere, right? Let's say it could flow to bonds, making the bond yield become lower, and then some will flow to stock market and then pushing up the stock prices, right? But once people start to draw down, you will draw down from somewhere, right? It could be some cash saving that you have, or it could be some bond saving, or some people might need to draw down from their stock portfolio, right? And if this one continue to happen, then it seems that who is supporting the stock market, right? So I think this is also something that if continue towards this trend, is something that is quite worrying. Okay, the last one. Okay, this is last one already. That I want to show is the consumer confidence and the stock market. This is also quite interesting. You see that all the dots here, right? If the dots is higher, so meaning that the consumer sentiment is good, right? Say here, subsequent 12 months S&P 500 returns will tend to be lower. You see, this is high dot here. the return is 6.2. And then when the consumer sentiment is very bad, right, the subsequent returns is plus 22%. So here, this is high sentiment, low returns, low sentiment, high returns. So back and forth. Right? So there's quite a strong negative correlations. And you can see that here, November 2008, consumer sentiment is very bad, right? Then subsequent returns very high. And of course, I think this is outlier, February 2020. This is just prior to the COVID crisis, right? Although the consumer sentiment is good, but subsequent 12 months is very high because of all the central banks interventions, so QE and stuff. And now where are we, right? We are at a very bad consumer confidence, okay? And if you just look at this chart, I think this is like, the chart is just the chart, right? But if you believe the strong negative correlations, right, what it means is that the forward 12 months returns could be good because now really the consumer confidence is really low. And this is the definitions, right? The consumer sentiment is the economic indicator to measure how optimistic consumer feel about their finances and the state of economy. And right now, right, if you do the survey, right, I would say that majority of people who are looking at economic data, they are all agreeing that the economy is not good. So, and it's all reflected in the stock price anyway, right? So if you think that this is point towards like, okay, because the confidence is weak, market prices are already reflected that. So I think this is just a good time to accumulate stocks. Okay, this is I think this is nothing much, right? Just showing the unemployment and wages. So I think in the past when the unemployment rate is high, right? When the unemployment rate is going down, meaning that people can get their jobs, right? So the wages, there will be a upward pressure on the wages. And where are we now? I think since the COVID recovery, we are seeing that the unemployment rate keep on continue going down and down, right? So from this 14.7% going down to now 3.7%, and wage growth is also increasing, right? And this wage growth is the one that push up the inflation. So this is where we are, but in terms of direction, we are moving towards the unemployment rate is expected to increase, and wage growth is it will continue to like going down. And I think from inflation perspective, I think this is all good. It's just that now we start to worry not on the inflation, but on the GDP growth and the general economics, whether we are heading towards a recession or not. Okay, I think inflation, we talk a lot I won't cover this. This is just to show that if you plot the chart from 72 until 22, right, you can see that the inflation rate is very high. So that's why central bank are panicking now. We won't cover too much. This is the one that I want to show. This is the global supply chain and inflation. I think in the past, let's say 3 to 6 months, we always say that the inflation problem is because of the supply chain, right? And now we already started to see some cool down in terms of the supply chain or the PMI input. You see the cost already come down. But the output prices also come down. So I think for those who want to take a spread, right? I mean, for example, like business, they have input prices and then how much they can sell for all come down. So I think this is also something that that is positive to show that the inflation will cool down. But it is not like this is not all, right? This is just one indicators, right? But recession, this is another things that I think in terms of mass media, they will pay a lot more attention to after the inflation problem has been solved. Then we have a recession problem. Okay, I think that's all. I think, yeah, we have more people already joined here. So I think let's go through the Q&A here. I don't know who will help cover all this, but I'll pause whenever after I read out the questions so that whoever want to contribute, you can help out a bit, okay? I'll go first this one, okay. Maybe everyone can share their loss point to make the pain more bearable. I think in the past when we asked this question, I don't think others will so eager to share. I think those who eager to share, you will see that they already shared in the chat group, right? So this one, let me show mine. I think people are always interested to see loss point. I also don't know why. Okay, this is my loss point, okay. So from the high, right, we're talking about drawdown from high of November until the current most recent period, right? My portfolio is down 38%. So I think this is more than what I expect. If you ask me, let's say beginning of the year, right, I would say probably 20% down is something that is normal, like 20% down, just normal volatility, right? But 38%, if you ask me, even with hindsight, I still think that this drawdown is a bit hard to swallow, like higher than what I expected. But in terms of the absolute numbers, right? 181,000 down. So this is the amount of money I lost from November until now. So, but I think this is fine. If market don't drop so much, right, how can we buy stocks at a cheap level, right? So I think this is the things that I want to say, right? There are always two different ways to look at it. There are people who always look at what already happened. Like, for example, this is my portfolio. This number, right, the down by 180K, right, this is already happened. They look at this, they are sad. And if I'm showing a big green here, right, I'm up by 180,000 green, right? Okay, I'm a genius, right? So you see, I'm genius. This is what like one way to look at it. Another way to look at it is this already happened, and usually we don't care so much on this, right? We care on how our portfolio will do in the subsequent period, right? In the next 1 year, 5 year, 10 years, right? And the market dropped by so much, it means that now stock prices is cheaper. I won't say it is cheap, right? It is at least cheaper compared to 1 year ago, right? And a low stock prices is always something that is very helpful for those who are buying now and then enjoy later, right? So this is the backward looking versus the forward looking. The backward looking is something that is very obvious one. You don't need to debate on. It is just like it is what it is, right? But the future one, because we can't see, right? Because from current period, it can always go down further or it could recover, right? The future is not clear, and that's why people don't look at it. They will look at what is clear, right? Imagine if you are driving, stuff that is in front of you, you cannot see. But you can see backward, right? I think take that as an analogy. Actually, most people will actually look at the back when they are driving, because in the front is blur anyway, but at the back is clear, so they will look at the back, right? So I think this is not a good way to drive a car, even though the future is not clear. But if you're driving, your car is moving forward, you still need to look in front, not looking at the back, right? So this is lost point is always something that's looking at the back. But I would say that just remind yourself to look forward. Okay, I actually quite looking forward to the future, because we are seeing that the business are, the earnings or the future, even though if you say recession will come, all these things, right? I think strong business that will still perform well in over the next 3 to 5 years. I'm not worried on that now. Business cycle, usually we're talking about like couple of years things. It won't stretch like we don't tend to have a recession that lasts 20 years, this kind of things, right? It won't be that long. Usually it will be like, okay, 2 years, and max, let's say 2 years or even 3 years, right? Then after that, after all these tough periods has passed, right, then we'll be heading towards recovery. And the questions is always that, what have you been doing during the recession? Are you panicking? Stay on the sideline and just like read all the perma-bear articles and say, I don't want to lose all this money, I don't want to be stupid, or you are doing something about it, right? Yeah. So that's the thing. So okay, I'll stop here just to give chance to anyone, right? Anyone you want to share your lost point. I'm actually interested to hear like it could be percentage, right? If you don't want to disclose the size of your portfolio, or it could be anything. I'll stop here a couple of seconds just to see anyone want to help me out on this first question.
Yeah, I can share my lost point. I'll just share my screen, okay?
Yeah, I think share screen. Okay. Let me unshare mine first. Stop. Okay, please go ahead. Boonsong, are you? I think you are.
Give me some seconds because I need to.
Okay.
Sharing Max opinion.
Quite interesting. Someone volunteer to show lost pawn. I don't know. It's quite interesting. Like show all the good stuff, all the slides. People say boring stuff. JP Morgan slides are boring. Boonsong's lost pawn. Let's take a look. Here we go.
You all can see this?
Okay, now we can see.
Yeah. Okay, so just list my top 10 positions. So what's in the bracket is the value of the position currently in relation to the portfolio weight size. So the one highlighted 20% and above. So the last 5 positions, we got number 6, Chinese, number 8, also listed in the Hong Kong Stock Exchange. And when we go right up over here, the extremely heavy damage one are all Chinese positions. So as you can see, it's quite bad. Yeah. So Alibaba is 10% of the whole total pot, and I'm also down -32, even though I started buying relatively later than most people. Number 4 is a Chinese group company, a Chinese company that like most Chinese developers are heavily sold down. Yeah, so this is not a recommendation. It's not a recommendation to buy anything. This is just a sharing session. Yeah, that's all.
How much? Let's say if we look at the overall portfolio, what's the drop?
Year to date, I'm down 15 point something %. So I'm used stock at Cafe to look at the sell down. I mean the year to date performance of all the indices. So I mean everybody when they look at their year to date is different. But when I look at Stock Cafe, I'm down 15, and I look at Hong Kong and United States, they are down 19 point something. But I think the Singapore Stock Exchange is up by less than 5% or just 3%. Yeah, so I'm running slightly ahead, although slightly ahead of the Hong Kong and United States market. Although I think a negative position is still a negative position.
I think the next question is like how do you feel right now? Like if you look at the red, like how do you positions forward, or like how do you manage your own emotional at this point?
You have to be very honest with yourself. So let's start from the back. All right. I know this is a cheap company, so I will still hold. Although how long it will take for me to realize my profit is another matter. All right. This one is a arbitrage position, so I'm not too worried about this. This one, because the weightage is low, so I'm not too worried about this. Number 6 is a mistake, so I know that I should have bought in a little later because it's not cheap when I started buying. So I can accept that I'm down 20%, 21%. All right. Whereas number 5 is a REIT that was sold down during COVID, and I bought in because I think it had a least leverage gearing ratio among all the REITs. But after some acquisition in recent months, recent years, it's not that great either. But I listened to a seminar from hosted by the CEO. So I think this guy is not too bad, quite honest. Yeah. So when it comes to the very bad positions, number 3 and number 4, right? Start with the management company. The one deals with property management. If you look at the balance sheet, it's still very solid. So I'm not too worried about that one, number 4. But the real estate one is really a high risk, high return. If I survive, right, if I'm right, I will make money. Yeah, I will make quite the decent amount of money. But if I'm very wrong, I will lose everything. So this is really high risk, high return. Whereas for Alibaba, I think it will keep pace with inflation. I'm not too optimistic about Alibaba because I always look at figures pretty conservatively. I think when I bought Alibaba back then, I didn't think it was really, really very cheap. So I was more of thinking that maybe the market was too cruel. And I always thought that when it comes to blue chip companies, the recovery is always faster than smaller companies. Yeah. So when it comes to position number 1 and number 2, I think I'm not worried either. The number 1 position is because it's another chip company. Number 2 is not that cheap, but because it had a lot of debt in the balance sheet. But I think going forward it would do okay. Yeah.
So actually just look at it because I don't know like all these companies in details. Right? I just want to get a rough ideas on overall basis, right? If you look at the positions, let's say they are down 10, 20, 30%, right? My question is like, do you like monitor their, let's say their fundamentals in terms of their balance sheets and earnings? Do you see like, is it like just the share price drop, or is it like you are seeing that their earnings and their fundamentals already deteriorated? Is that the case, or there's not at all? It's purely sentiment. I just want to know like what are those situations?
You mean in other words, what's driving me to buy more or just hold?
Not really. Like what has happened since all this drop? Like is it like just sentiment bad, but their earnings balance sheet they are all still fairly stable, or is it like their fundamentals really we have seen some deterioration?
I think for number 3 and number 4, it's really fundamental deterioration. Number 1, number 2, and number 5 is not. It's really market sentiment. Okay. And number 6 is slight deterioration in earnings power. Number 7 is unknown market. Because this company, number 7, it holds quite a lot of Chinese debt. So the thesis is that you have to trust that the management know what it's doing. They characterize the debt sufficiently, and if the thesis play out, I think the returns will be okay. Number 8 is a Taiwanese. It's a company that holds pretty much a lot of shares in the Taiwanese bank. So there's geopolitical risk here. There's some kind of political risk involved. Its balance sheet is also very strong. So I think number 8 is more likely a market sentiment thing. Number 9, I will not comment. Number 10 is I will be very blunt about number 10. Number 10 is a spin-off play. So it looks cheap when you consider it from an equities holding point of view. But if you look at the financial statements, and you realize that there's quite a lot of debt. So the debt involved is actually not that cheap. Yeah, but I say because the weightage is low, so I'm not too worried. But earnings-wise, it was not impressive when you released its figures pre-spin-off. So I'm not too worried about this one.
Okay, thanks. Actually, one last question, right? How do you plan your DCA, or do you have any like your upcoming DCA planning? Like, how do you strategize? How do you allocate within this, or you're just because you already make your investment, you're not going to add, or just some comment.
Normally, right, when let's say there's a huge amount of percentage drop in one of the companies, meaning that maybe today this particular Chinese property company dropped by maybe 10%, 8%. The first thing you want to do is to look at what others are doing, right? Because the market is controlled by largely institutions. So when they sell down by sectors. So if it's really just a single company movement, you want to look at the announcements or even news and to see whether there's really any kind of a special something's wrong happening to that company. But generally, I don't DCA. So I look at maybe a certain company like number 8. If it drops by 10%, it's a very comfortable buy because the balance sheet is very strong. But when it comes to the top positions, I will be a bit hesitant because when you look at maybe number 4, and then if it continues to drop further, right, it's not really going to move the needle if I buy a lot more. And So I don't really DCA. I look at the kind of company that it is. The thesis why I buy it because it's cheap based on balance sheet. If it's based on earnings power, I'm a bit hesitant. So when it drops by 15%, another 15%, I can tell you that I probably won't buy a lot of number 4. I'll probably buy a lot of number 1, number 2, number 5, maybe number 6 and number 8. Yeah. So it's largely at how likely they are able to survive by looking at their balance sheet.
Okay, understood. Thanks a lot, Boonsong, for sharing. Okay, might need your help to stop sharing.
Stop sharing my
because if not, it will. I can't share. We can share 2 screens. It's just that the recorded one, right? It will be like one big, one small, very weird one. So I need to share back my screen. Okay, we are back here. Anyone else want to share your lost pawn or want to comment on your portfolio? Just, to entertain everyone else. No one? Okay, so only Boonsong. Okay, thanks a lot for your volunteer work. Okay, let's look at the others. Okay, this is done. What's your view on Mastercard and Visa? I'll just point to who want to answer this? Want to give comment on this? Or Boonsong, you want to try on this?
No, I don't have insight on these two. I only look at small companies.
I see. Okay, I'll just briefly comment, but just want to let you guys know I don't have exposure in Mastercard and Visa. My view on these 2 companies, right, is that when we talk about like companies' moat, right, I think one of the strongest moat is the network effect. Network effect means that they always have this spiral one. So because there are more users using Visa and Mastercard, and then there will be more vendors, and then there will be more companies that will take on this as a payment methods. So this one, their network effect is very, very strong. So very, very hard to get outside of Mastercard and Visa. What these 2 companies are doing, right? Basically, they provide the rails, right? It's like the physical rails, like the train rails, right? They provide the rails for all the messaging of like the payment instruction. Like basically, when you swipe a card, what happens behind the scene is that all this instruction to pass it to the bank, to make the payment, to transfer the amount, and so on. Or there are quite a lot of things happen behind the scene. But what Mastercard and Visa are doing is that they provide the system or the infrastructure for all these messages to get abroad, to circle around, and very hard to get rid of them. So because they are already entrenched in, and very, how to say, dominant in this payment industry, right? Even I can give you an example is that, when Apple, they try to do the Apple Card, and then they get Goldman Sachs to partner with them, right? And then they say, okay, their solution, Apple Pay, is very, very, how to say, very seamless. You just tap and then the payment is all done, right? On the surface, on the UI, it is very, very easy to use. It's very intuitive. But actually, behind the scene, they still need to come back to I think they also partner with Mastercard, right? So you can see that it's very, very hard to get rid of them. Like when it comes to like all this payment infrastructure, right? They are always there one. So I think in terms of their core business, right, they are very, very strong. And then the other thing is that beside their core business, they also have all sorts of like all the technology stuff that is in the payment industry. I think they invested in startup and so on, right? So they are also very big in those areas. So I think their positions, right, is very dominant. It's a bit like Adobe, like when it comes to this niche, right? For Adobe, this is like all the creative works, but for Visa and Mastercard, this is everything about the payment, right? They are very strong and then very hard to disrupt them. So this is the good thing. The bad thing, right, is that payment industry by itself, right, is kind of matured already. So whenever you see there's a recession fear and so on, right, because when recession hit, what happens is that people lose their job and they can't spend. And when they can't spend, Visa and Mastercard, because their revenue structure is basically take a percentage cut of all the transactions, right? So they will get hit. So that's why for these matured sectors, their growth rate is not like super high one, right? So whenever there's a recession, they will get hit, right? So that's a short-term concern. A longer-term concern, right, is that, you know, when talk about like all this payment, right? In the past, yes, I think they laid all the rails first, right? So everyone just tap on their infrastructure and just use them, right? So they find it very hard to get rid of Visa and Mastercard. But when it comes to payment, actually what happens if let's say I want to make a transfer or a payment to you, right? Actually what happens is just information change, right? Like I pass information, like there's one database that track how much I have in my account, and then check how much you have in your account. And then when I say I make this payment to you, it's basically just pass on the information to the database and make the ledger changes so that now my money is transferred to you, right? And if you just look at this on like the core basis, right, actually it is not that hard given that we have all sorts of different technology, including all the blockchain technology and so on, right? So I think there are already quite a number of startups that try to get rid of Mastercard and Visa. And in terms of technology, right, I don't think it is that hard to get rid of them. The problem is not about technology. I think there are many technology that is more advanced than what they have currently. But the hard part is that it's very hard to disturb a business that is already have the network effect. Like they are already dominant, right? So this is also a bit similar to like brand mode. You can create a handbag that is better than LV, right? For example, right? But then you can't just suddenly build your reputations and then just make all the rich people to buy your bags, right? I mean, it's something similar to that. So I think their core business is strong, but I myself, I don't invest in them just because I'm not like, I just don't really think that I'm a bit afraid of the long-term disruption that coming from all these startups. And I'm not expert in this area, right? So I don't know like how soon they are able to disrupt them. So there's some long-term concern. In terms of short-term, I think recession, I think this will hit all companies now. But in terms of innovations, this is also something that I can't tell in details what they innovated in. It's just that when you look at the startups, I think probably if you look behind the scene, who invested in all the payment startups, right? I think Mastercard and Visa, I think they are usually have one of the investor as well. So I think this is just a broad comment on these two companies. I'll stop here just to see anyone want to help up a bit, just to comment like what's your understanding on these two companies. Okay, no comment. So I think overall, I think I wouldn't say they are bad business. If you look at their like revenue, look at their earnings, these are mature companies, have a strong mode, a bit similar like Costco, LV, this kind of companies where you won't be afraid that they will go out of business one. So I won't be afraid of that. I think they are strong businesses. It's just that whether I want to invest in them or not, there's a bit of like preference, right? So there are companies that I know more about and I'm more interested to own than these two companies. But in terms of like just look at them, like for example, companies like Adobe, I will put into same category as well, right? They are very strong in their niche, right? But do I want to own them also depends on my own preference. So for me, I'm not owning them, but I recognize that they are both very strong. Okay, I will stop here. Let's move on. Do you see a financial crisis like in 2008 or worse coming? I just see around. Anyone want to give your comment? Just see.
I do. I see it.
Yeah, please go ahead.
Yeah, I see it because I see that the credit default swaps, the spreads are getting very big.
Which one specifically? Are you talking about the sovereign spread or corporate spread?
Both actually, but more of the sovereign ones are, yeah. They're all getting bigger.
Sovereign one, which country?
Like you see Canada, USA, Japan, all getting bigger.
So this one is showing that there's sign of crisis coming now. Do you have more to elaborate on?
Wait. I'm trying to find the page. I have. Wait. Yeah, I post it in the chat. Wait.
Maybe while he's posting, right, Maybe for the rest of us, maybe Kenty can explain what is credit default. Credit swap.
Yeah, credit default swap is basically your transfer pricing, not transfer pricing, transfer risk. So like basically you go and buy whatever thing you can. Let's say you buy a bond or something, and then you want to protect yourself from like the default risk of the bond. That means the bond payer stop paying or something, right? So you go out onto the open market and find some other party that will just buy the default risk lah of your whatever instrument. So they maybe like, let's say they maybe like charge, say, okay, for this I'll insure your amount if the company defaults on your bond for like maybe $5 a year or something like that. Yeah, so that is the credit default swap. That is the base thing about that lah. So typically when financial markets are healthy, the credit default swap spreads are very low. But when the markets are very volatile or very people are afraid that people might not be able to pay, then you start to see that the spreads get larger and larger. So right now the spreads are quite large historically, compared to the last 10 years.
I think I saw it in the also in Twitter. There's someone mentioned that there will be one international investment banks that will heading for a big problem, insolvency, I think. So there's speculations. I think the name is Credit Suisse. Some say that they are having some problem on their balance sheet and so on. And I mean, similar to what is showing on the page here, right, which is the credit default swap for sovereigns. This is basically saying that, let's say if you can pay, let's say 1.8% a year to insure your Italian bonds, right? But there are similar CDS for the corporate, and the CDS for Credit Suisse also is getting quite high at the moment. So this is all, because I think these are all like derivatives, right? And they are tradable. So they always, like, this is a good place to look at to see actually what are the traders are positioning, because if they see that the company or the country is defaulting, right, so they will buy the insurance before it defaults, right? But the Credit Suisse one, I think, is quite interesting, because come back to the questions, right, where the question was asking, like, do you see a financial crisis is happening, right? I think if we just look at the recession and so on, I don't think you can suddenly have like mild or even steeper recession and suddenly we get into global financial crisis like the 2008, right? I think you need to have something that really break, right, in the market or in the financial world. And usually these are like, like systematically important institutions. For example, like a big investment bank, or it could be like a central bank that just go bankrupt, also possible, right? This kind of situation when you have a big and important organization that just went bust, and then there's all sorts of all these like collateral and then counterparty risk just increase, right? And the financial market just stop working, right? And that's when we get something as serious as 2008. A typical recession, I don't think it will have this kind of situation. But in the past, I think central bank, for example, like Federal Reserve, ECB, they will step in, right, in this kind of situation. Even recently, BOE stepped in to save the UK bond markets, right? So I think the question is more like, if these things happen, then all the central banks step in again. Could they, like, avoid a big catastrophic event and things will get back to normal, or what if they don't, right? So I think that's more like things that we can't see in details, at least for now. You have any thoughts on that, YCX?
Well, the thing is that in the previous times when they stepped in, right, is the inflation is low, so they can step in and there isn't much of an issue. Now that the inflation worldwide is so high, and they step in, the other risk that they actually face is that they lose complete credibility in their currency altogether, because you can imagine that if you are facing inflation of like 5 to 10% and you step in to provide even more liquidity, then the system is just going to be inflating all the way, because ultimately central banks is kind of like it's not exact. Okay, think of it as this way, is that the inflation is not like a 0 or 1 kind of thing, like where you either have inflation or no inflation, that kind of thing. Inflation is more of like it's like a it's like a scale, but the scale itself is not a linear scale. It's more of like a exponential scale. So at the start is the effect is very minimal, but if it gets going, it really gets going very quickly, because the expectations adjust, and then people kind of factor in that there's going to be inflation, and when there's going to be inflation, they will charge more in advance, and they will charge more in advance, then that will lead to the factors inputs costs go up as well, and it will just keep cycling. And obviously this will hit businesses that that have a more elastic demand for their supply, because they are unable to adjust their prices that quickly. But for like businesses that focuses more on like things like food or energy, they can adjust more rapidly to uh to counteract this. Yeah. The issue over here is that when you have when there is like low inflation and your central bank do this kind of adding liquidity, right, which is essentially printing money, if you think about it in that way, you add liquidity, your markets can kind of like allocate that liquidity efficiently to the places where it needs them, and the rest of the places are not going to be that responsive or reactive to that extra liquidity. But now you can kind of see that the market itself is pretty clear for the past year. It is moving all in tandem with the Federal Reserve policies. So any change in whatever central bank policies, you'll see that everything in that country just changes together to move accordingly. Yeah, that is how it is now. The macro market is responding to exactly just this thing itself. Everything is correlated to this, which is quite dangerous in the sense that once liquidity is injected more, the people might actually feel that it is risky and we better start to buy something that can store value over time, which can be any number of things. Yeah, but historically speaking, it is usually the same field, which is land, which is gold, which is like energy, which is like metals, which is like now, I mean, for the past 10 years, there's crypto. Depending on what are that, they will just start to move money away and into this kind of assets. Yeah, just as like a counterparty risk kind of thing. Not the full amount, but they will move some amount to it.
Yeah, I think I also noticed that when Federal Reserve, they say they want to increase the interest rate and they do tightening, then I think ECB also follow, the rest also follow, right? The one that doesn't follow is actually the BOE. Because I think what happened in the past 1 week is that the UK government just suddenly said instead of raising tax, they are cutting tax, and then they're spending more just to help cushion the inflation, right? They are subsidizing all the energy costs, and then market doesn't react positively. Yeah. So they basically just vote the no confidence vote. Basically just sell out all the long-term government bonds, and then that hit their pensions and all sorts of problem happening there. And BOE suddenly need to step in instead of like doing the quantitative tightening. Now they are doing like go back and buying bonds. So I think this one just shows that when a country, especially UK, considered, I don't know, is it like big or small, but when they do something that is a bit like out of the norm, right, then you can see that things just turn out to be quite ugly. So even I think the pension markets is like, or the long-term government bonds market is like melting down. So
and it looks
scary.
like they are facing, like they are going into like the teens for inflation next year. Like solidly in the teens for inflation already.
Yeah, definitely looks quite serious. Okay. And anything else you want to comment on this? If not, we move on to the next question. Okay, I think this one, of course, talking about Tesla, right? What are your thoughts on Tesla human robot prototype that was shown at the AI Day? YCX, you go first.
I mean, I did kind of mention it is a good first attempt, and a lot of it will depend on like the case. It is. I mean, you can just look at the full self-driving thing, which is that you will start off with something and it looks good, but then there's going to be so many different fringe cases that will happen, and in this case is an even higher challenge because like you can kind of see from like planes does not need to like factor into account like random passerbys because plane space is relatively clear and objects are large. You probably only need to account for other large objects, the weather, and possibly birds. That's about it for planes. Then when you get to cars, you have to account for like random passerbys, random objects falling into your way. Then like you have to factor more into account like your size or your bag or whatever. Someone might ram into your car, someone might hit your car from the side, all these kind of things. The complexity scale is larger. Then when you come over to robots like this, the complexity scale get even larger because you have to now take into account that all kinds of things can happen. I mean, you just think about it. You as a human, you go about your day. Sometimes you are together with your friends or whatever, and you just do like a action, and suddenly your heads bump into each other. Then it's like, ow, it's painful, this kind of thing. And if a robot does that with you, it could be quite disastrous as well. Like somehow the robot is unable to sense that you are directly behind it or something, and then it just stands up or whatever and hits you in the head, and then some kind of issue happens. These kind of things can all happen when it comes to this dimension of like movement. So it is it is kind of like you can kind of also see in what Elon Musk say or doesn't say when during like the full self-driving thing, he was quite confident in promising, like in the past he was quite confident in promising that full self-driving will come like within 1 or 2 years, that kind of time frame. But of course, you can see that the 1 or 2 years end up to be now already like 4, 5 or 6 years, that kind of thing. Then for these robots kind of things, he's not even giving like a concrete timeline that they will come out like something that is consumer ready within the next 2 or 3 years. It's more like he projects it out to like say 3 to 5 years kind of thing. So you can kind of see that it is still like there's a lot of issues they need to figure out first before it will finally be able to be on the market kind of thing. The other closer example would be more of like the robot dog that we see moving around with like a loudspeaker or a camera, that kind of things. But those are not human size, so the scale is significantly smaller already, and they don't really do like human size of tasks as well. So that is the kind of things that we have to look out for when it comes to that.
Thanks a lot for the comment. I actually agree with you. I think the part that you say there's more interaction, this is definitely not appreciated enough because I think I've heard the comments say, okay, actually you talking about cars, FSD, you are driving at 150 kilometers per hour. So a little bit of errors is actually big errors, right? For example, like it can hit someone, it's quite dangerous, right? Whereas for robot, yes, it's moving very slowly. You can do more stuff, and then it should be relatively safer as compared to FSD, right? Where you have 2000 kg machines that is speeding up, right? You can do more things. It is relatively safer, but then really people will do even more things, right? Just for FSD, already there are people doing all sorts of crazy experiments that might be harmful to others. When it comes to robot, I think the imagination would just like, there's no end to it. People just use it for all sorts of different reasons, like a basically treat it like a toy that can hurt others. I think this is also something to watch out for. But let's see. I think their plan is to make sure that these things is something that is useful. I think they will use it for their own factory first, right? So let's say if we have something like, just look at the pace of the improvement, right? I think just within 1 year or so, they can come up with something that's working. I think this is all good start. Then the rest is look at over the next 1 to 2 years, see what they can come up with. Is it something that can be really useful, at least for them first? Then I think the mass market one, I think for consumer, I don't think that is so soon. I think, like you said, there are many things to work out before they can actually launch it and make it become like a business.
Yeah, and the other thing would be the cost. Because cost-wise, the market, I mean, the market will probably be there, but the start of it will probably be something like putting it in specialized places first, like hospitals or something, because they have to find like certain industries that will require such robots first, that can actually like order from them, that has like some level of human interaction first, because you can't exactly put it out to the mass market like that when there is so many different kind of things that the average consumer user will do, and it's not exactly monitored. Yeah. But if you put it in more of like a industry environment whereby part of your contract stipulates that you can have camera footage of your robot doing stuff or whatever things, then you can kind of see where are the different things that needs to be improved upon for mostly for safety reasons. That's the number one priority of robotics. That it has to be safe enough for people to be around.
Yeah, definitely. Something like a robot that's at food court, just running around collecting plates. I think that one is also some use case, at least. I mean, the term useful, right? It could be like not too hard, right? You can have a small use case, but the harder part is that how to justify a 20,000 or even more, right? Let's say 30,000 cost of a robot, and you want to make it as useful as a 20 or 30,000 machines, right? I think this is a high bar, but at least small use case, I think there are all sorts of ways to implement them. Actually, when I listen to the entire like 3 hours, right, the robots things I see as like a start, right? It's just like a platform that they can work on it, and then they can basically they will be very busy over the next 10 years just for this entire robotics area. But the part that I think is quite interesting is the Dojo one. The Dojo, because I think the AI day one, right, they only mention like a roadmap. I don't think things are working at that time. They just started out, right? And they have some high level thinking on how they are going to approach things, right? But over the past 1.5 years, it seems that they are already have some good traction. Although I don't think it is complete. They say the XR port will be ready in 2023. I think this is their schedule. But compared to the AI day last year, is that this round is more concrete in terms of what they are able to showcase, like at least working prototype, right, and some measurement in terms of their performance. So I think this is something that I still remember the AI day one. They show that okay, actually it's very easy to deploy their Dojo. They just change the CUDA to Dojo, and then they can port over and can just use their all these chips for the AI trainings, right? So I don't know. I think as of now, like I agree with most of the stuff that you share on the group, right? Which is that at the current stage, even we're talking about 2 to 3 years, right? I don't think they can just come and say, okay, they're eating Nvidia market share, right? But let's say just look at what kind of advancement that they have, and then the use case or the capability that they have, right? Is that something like this area could be something that actually they will compete against Nvidia quite hard now? Let's say looking at 5 to 10 years kind of outlook. Do you have any comment on that?
Okay, the thing is that when you think about AI and training and models, all these, there are many segments within it. So, like, obviously at the start, if we go back to history and we look at it, this AI and machine learning kind of thing started about 10 years ago. I mean, it really kick-started about 10 years ago. The whole idea of machine learning has been around for 50 years, but it's only in the past 10 years whereby the machine started to be capable enough for them to do it. Because it's actually a very intensive process in terms of like computation. But so what happened at the start was that for machine learning, the very base case is that you machine learn with numbers, which is like you just I give you this set of numbers, and given this set of numbers, can you predict what's the next number that will come, that kind of thing, which is what you know as your like best fit line kind of thing. That's like the most default really. Okay, so you can see that they work with numbers first. Then the next breakthrough was that they started working with pictures. And how they work with pictures was that through like, because picture itself is no longer single dimension, because numbers are single dimension. When you look at like photos, right? Photos are actually about two dimensions. Okay, how do I say it? It's more of like a one times three kind of thing lah, because sorry, two times three kind of thing, because you have like your pixels, the left and right, because not left and right, left and side and top, and then you have the color of it lah. So it becomes that you have to look at each and every pixel, which is like the color and the color and the color of it lah. The color is represented by three numbers, that kind of things. So you start to see that they move towards like this two-dimensional plane, and then videos is just pictures, it's just moving pictures, so it's the same thing. So then now you start to move into like more and more complex fields, because you have to start bringing in data from different areas, which is like, if you just look at driving alone, it is actually like moving pictures, videos. Then you have to also factor into account like other things, which is like it can be a very number of things. It could be like your car weight, it could be like your car size, it could be like signals from elsewhere or things, or noises or stuff like that. You start to bring in all these dimensions, it gets the problem gets exponentially harder, because a lot of the things is context driven, and context driven you start to have that kind of things. So as you start to move further and further in, the machine learning models isn't going to be just about like 2D, 3D, 4D data. It's going to be multiple times, because you have to start working with like objects that have more attributes, rather than just look at it from like a 2D or 3D plane of things. Yeah, that is the idea of like how AI has to scale up lah. And how does this tie into what I'm saying is that you can solve for the current problems now, which is that, I'm going to be so fast at a particular problem, but the future problems that come in are not necessarily going to be on the same kind of problem set that you have. It's going to bring in more dimensions of data that you have to fit into your existing models, right? To be able to use it properly. Yeah, which is why you can also see, even in machine learning models itself, at the start you have things like CNN, and then now they move towards things like transformers. And there was a time whereby there was this what is it called, LT something, LTM something, that is like a basic look behind. Now your transformers have even more look behind to bring out cases and to amplify the past cases context, that kind of things. That is the main problem that is facing AI, that you are trying to develop for it, but the problems that come are going to require developments in many different areas, not just in what you are solving for. Yeah, another example I can give is that you start to solve for like compute speed, and then you realize that your compute speed is so fast, but then you realize that the bandwidth speed is low because you have to bring in more you have to bring, sometimes it's about the data feeding into your system, how fast you feed the data, and it's not about your compute speed. Then you have to solve for bandwidth speed as well. Then after that, you have to solve for all kinds of things along the way. And ultimately, in this game of who can develop the best AI chip, right? It is not about like one particular measure or factor, but it's more about like how fast you can iterate. That means how fast you can release your next generation to fit that generation's use cases. Yeah, because if you just develop a product and you expect that you'll be able to sell it for like the next 2-3 years with minimal upgrades, right? It is not going to work out. Which is why you can see there's a lot of like those AI chip startups that they do their own chips and startup, and then they get into this issue whereby they don't have enough marketing power or support to be able to get people to buy their chips, and then they are stuck on that particular iteration or generation of their products, and then 2-3 years down the road you start to see that some other new problem comes up that needs even more power in a certain area, and then there will be another generation of chips that are marketed to solve that particular set of problems, and you have to keeping up with that. Otherwise you cannot have a proper business model in the area.
So are you actually saying that, let's say if we take Tesla current approach, right? Because I think they can have a very good performance is because they, they look at their use case, which is their current FSD use case, right? And they say, okay, this is how I should design my chip and the Exaport and so on, and their Dojo, right? And then to fit their use case. But you're saying that, let's say, looking ahead, let's say 2 years, 3 years later, the models could be different, the context could be different, and basically whatever that they are building currently might actually become useless, and they have to build the entire new, new technology on the hardware side. So they have to, basically all the costs that they spend on the current Dojo will be like become useless in the future. Whereas for Nvidia, which is using, let's say, a GPU, which is more useful for generalized kind of use case, right? They will be more reliable because although, yes, they are slower, they don't fit the current one, but at least they can fit better whenever what kind of models changes in the futures, right? They can just change to that because of their flexibility, right? Is that, am I like thinking on the right
yes,
way?
essentially is that, but it's also essentially about like how many enterprises you are working with, because you have to kind of see the enterprises out there and what they are requiring. And like if you are a leader or you are a business leader, you're not thinking in terms of like, oh, I'm just going to buy the best solution for this year and that's it lah, like that, right? Like if you are like big company, you'll be thinking, okay, I want to start up this division, and this division is going to be around for the next 5-10 years or something like that. And the problem, what is the problem statement I'm trying to solve for? Maybe the problem statement I'm trying to solve for is like full self-driving. So maybe since the problem statement I'm trying to solve for is full self-driving, and I estimate that it's going to take me like 5-10 years to like build it out and then to market it, and like maybe it only start giving me like returns in like the third year onwards or things, and then it only starts getting profitable in like the 6th year or something like that. Then my horizon becomes so long, and I have to start thinking, do I really just buy the best solution on the market today, or is it worth it for me to partner up with some other company that can provide long-term solutioning, or is it worth it for me to actually spend the R&D cost and build up my own solution? So you have to actually think about it in these three sense, and then of course once you think about it in these three, then you also have to factor in whether you have the expertise or the capability to build up your own solution to manage whatever things. These are all like project cost factoring things you have to bring in, and it just so happens that Nvidia is in this kind of position whereby they are the ones who are innovating in these areas and developing out solutions that, hey, they are just saying, hey, these are the solutions that we kind of think you need in the future, and we are willing to work with you if you just partner up with us, and we can develop together on your in-house side and our side to see whether our solutions fit into what you want to do, that kind of things, which is why you can see that the entire enterprise side, right, for Nvidia is not really like we are going to just I mean, there is still we are proud that these are the solution speeds and things, but it's not really like it's really more of like looking at the different use cases. You just see their websites. There is more focus on like, these are the use cases, these are the kind of solutions we provide. If you're interested in these solutions, contact us and we can work something out. That kind of marketing, yeah.
Yep, quite interesting. Different positioning. I'll say that although on the autonomous driving, right? I think Nvidia is working with many different. They are basically working as a partner for many different startups and also auto manufacturers, right? And then on the other hand, Tesla is doing their own thing, own FSD, own even chip design. This one also quite interesting. And it seems that if they have a traction here, I think this capability is still something that I think it's worth something, right? It just shows that they really have a different culture, and I don't think they want to build all these things just for the sake of building it. It's just that whatever that is available on the market doesn't fit their own use case, right? Then they have to build it, right? So I've seen that. Yeah.
The other thing is that we have to recognize that Tesla is a special case in the sense that Tesla has been like a outstanding company in terms of getting funding. So when your company is getting so much funding, right, you start to think differently, and you are able to look at project costs differently, because you can project further out. Like, your stock is so valuable, so many people wants to lend you money, you can sell them on like long-term solutioning. But when you look at like other companies that do not have that kind of clout that Tesla has, it's actually a dollars and cents kind of problem, whereby they have to look at like, hey, if I want to embark on this 5-10 year project, I have to clear with a bunch of people, and I have to clear the banks as well that will be providing me funding, providing me like covenants that I'm like, some banks that provide me funding might say that I have to run through whatever new projects that I start with them, and then they have to see whether it is something that they would like, or that kind of things to fund and stuff. These are the things that start to come in, that you have to then scale back your horizons in terms of like how far you can actually project out. Yeah. You take a look at like just look at the next closest company that is trying to do something that is like far out, because these are all far out projects. When I say far out, it means that the demand is not there yet. There is no market for it, and you are just building something visionary in the hopes that when you are done with it and people use it, they will kind of say, hey, this is something that I actually like. And that is the same for like FSD and EVs, which now you start to see that there is this market for it. But back when Tesla first started, the market wasn't even there. Yeah. So you start to see like, even for like Facebook, Meta itself, right? They, at the start of like last year, they were projecting that, they were going to like build out Meta and is going to have like a high cost driver. It's going to be a high cost driver, and they're going to spend like, I don't know what was the number, like 5 or 10 billion or something a year or something, right? I don't know the exact numbers. But then just in this year around March or April, you start to see that they start to scale back on that already. They start to say that, oh, we are going to spend much lesser on it, and we are going to focus more on our key revenue drivers now, and we are going to cut back on employees. We might fire some people, that kind of things. You see that the mindset starts to change when you start to have like this kind of long-term horizons, and then the bankers are like pressuring you down on like the financials of it. Yeah,
exactly. And this one is it's a bit like self-fulfilling, right? So because of the shareholders, they believe on the long-term trajectory,
Tesla
the
itself was
long-term
in
vision.
a very good position. They were able to have a lot of funding that is abnormal in the sense that people really believe in them and gave them funding that they are able to project further. I'm not saying that they are average company. They are definitely above average, but their funding is even more above average. Compared to their capability.
But the funding is the one that deciding whether they will fail or they will succeed, right? So that's the things. What I'm saying is that
imagine like your parents just gave you like a small loan of $1 million to run your business, to start out your first startup or something. Like obviously with a loan of $1 million, you are able to do a lot more things than someone who has to go back for like angel investing or look for like VCs or things, right? You start out with like 1 million. Whoa, your equity is already 1 million at the start. The things are going to be different in terms of like what you are thinking.
Yeah, definitely. Okay, I just want to see the floor here. Anyone else? You guys have any questions? Want to discuss this discussion on Tesla further? Yeah, because I think these topics is quite interesting to get into. But I still have a couple more questions, but I think we can cover that in coming weeks. I think we won't get out of it so easily. I think Tesla always a lot to talk about. Okay, I'll just move on first, just to cover all we have here. But some will be quite quick. How do you decide if a country is worth investing in? I don't have a lot of points here. That for me, I invest in US and then I invest some in China and so on. I think there are a lot of things to talk about. Like for example, like whether the overall market cap is big enough or not. Big enough means that there are some confidence on the entire financial market, right? So that's one thing, right? And second thing is of course all things regarding all the regulations. Are they like developed financial market and so on? So I think there are quite a number of factors. But I think just to look at these one-line questions, I think I don't know what to talk about in details. For example, if you just narrow down to the regulations, right, and talk about like China regulations versus US, right, and just narrow down further to antitrust, right, they are all very different already. What kind of, whether they're using US GAAP or whether you're using other accountings, and then what's their attitude or how do they present their books? All this is also another topic. There are many different topics to talk about when you ask a macro questions, right? So I don't know where to focus on, so a bit hard for me to answer in details. But I think that's two things. And maybe another thing is I don't focus so much on the country, meaning that I don't look at country and say I like China, so I must invest in China. Usually it's not the case. So I'll try to have more like bottoms up analysis. For example, we are talking about investing in companies, right? So the first thing to ask is that what companies that we're talking about, and then what are their business model? Are they profitable? If they are not profitable, how soon will they get profitable? How's their innovation culture, and what's their, do they operate in a business environment that is like conducive enough for them to succeed in the future? When it comes to talent, are they able to get talent because of their country and so on, right? So these are some of the questions that I will ask to determine whether I will invest in a specific company. But again, I don't do so much on like a macro top-down kind of allocations to say, okay, these are two countries that I like, and then I invest in companies in that country, but more on like bottoms up. So if there's any companies that is doing well, but they are like, let's say, sitting in other like a country that I usually normally don't invest in, as long as they are investable, right? For example, like they are listed in US, I think I'll still take a look. But let's say if you say their business itself, for example, like their revenue, 90% of them come from Philippines, for example, right? Then I will ask myself like, okay, is Philippines a market that's big enough, right, for them to grow and so on? And I still need to understand the macro of that country. So usually I don't take that kind of investment just because of the work that is required, not to say they are bad investment, right? So I think this is just a couple of points that I mentioned. Just want to see anyone want to help comment on this.
I would say you would have, a bottoms-up approach to a country for me would be that I would actually look at look at like in terms of like you have to read up their laws, and you have to kind of like ask around like people who go over there to start businesses, because fundamentally, if you are an overseas person and you go to the country to whatever country to start a business, right? You have to look at like how easy it is for you to start a business, and whether it's worth it for you to do business in that country. So then once you start to think along those lines of like starting a business in that country, right? And then you think along those lines, you think of country, right? And then you think along those lines, you think of what are my factors of input, what's like the labor laws like over there, what are the red tape, what are the application procedures, these kind of things, and what are the taxation, any other subsidies, that kind of things in that particular country. Then you start to think, hey, I can probably make it if I start a business in this country, or I think compared to this country, maybe if I look at like Southeast Asia itself, and I look at Malaysia, and I look at like Myanmar or something, and I start look at them and I say, hey, it doesn't look very right that I start a business in Myanmar compared to Malaysia, because Myanmar has some very unclear rules on how things operate, or some very unclear rules on like how money is operating, or that kind of things. Then yeah lah, then you start to think along those lines to start off whether you can run a business in that country. Then obviously this topic is very deep. Eventually you'll get to that kind of like Temasek or GIC level, whereby they start to think, hey, it's not just about whether I can run a business in that country. It's also about like what are the rest of my businesses in my portfolio, and how are they positioned together with that country, and is there any kind of like reasons other than profitability if I want to invest in that particular country. Yeah, for a person scale, it will be more of like for a company scale, it will be more of like supply chain kind of like reliance, supply chain reliability, and that kind of things. But for person wise, if you want to invest in that country, then you'll be thinking about like, is this a country maybe that I might want to live in the future, or maybe is this a country that I'm just investing because I think that it will be good in the next 5 years or something, and they will be doing well in the next 5 years. And you have to think about whether you want to invest in it like it to the scale of whether you want to live in it, or is it just another like investment whereby once you make a certain amount of gains, you exit that market kind of things. If it is the second form, which is this exit the market kind of things, right? Then you will have to compare with like the whole scale of like all the country, all the other investments that you can make in this world. because so it depends on what perspective you're looking at it from. Looking from it from like a strategic perspective, or you're looking at it from like a just investment gains perspective. Yeah.
Yeah, sounds like all these still need a lot of homeworks, when you talk about country, you want to understand inside out of a country. I think it's not so easy one. A lot of work that is needed to understand, because essentially like you operate on a different kind of like a platform, right? You need to know like the supply chain in that country. You want to know what is the attitude of the investor in that country. I think a lot of works, right, when you talk about like especially smaller countries, right? For example, you just bring out let's say should I invest in Philippines, or should I invest in like a Japan, specifically Japan? You want to understand inside out, right? So I think need a lot of work. So that's what I say. I'm not expert in this. I don't want to comment too much.
Can I say something? So
sure,
it really depends on the asset class in which we are talking about. I mean, if you were to ask, because this question is actually very broad. Are we talking about property? Are we talking about public markets? Are we talking about private markets? So, I mean, those are the three main ones, right? So it depends really very much on how that particular country and how that particular culture views that asset class. So for example, Singapore is probably the easiest place to start a business and run a business. But I would not, if suppose someone from outside of Singapore would say, I want to buy SGX stuff, I don't think it's a good idea. I mean, it's just not a great public market to talk about. So rule of law is probably the most important part, especially with regards to the asset class that you're looking at. If you were to buy a property, you got to see, okay, a foreigner would naturally have probably worse outcomes than local in most countries. So you got to be very familiar with the laws of that country, what sort of leases and what sort of rights you have as a property owner. If you're talking about a retail investment into public markets, then there's only actually very little choices that you have, because you don't want to go to a situation like CLOB. I mean, if you guys know 1997, what happened when Malaysia allowed Singaporeans to actually purchase equities from Malaysia. This sort of things can happen. I mean, you'll be targeted. So that's why US is so attractive, because we know for not just because of some legal framework that you as an investor are protected. It's their culture is such that the entire society will rise up and riot if suppose the government decides that the capital class should be confiscated from. That's just the philosophy of their culture. So if you were to do the same in China, China can very well just confiscate the entire stock market, and the population would be more accepting of that. So that's why possibly if you were to invest in a country on the public market, it's so difficult to talk about China or India, because you never know what the government can do to abuse this investment. That's just my thoughts on this particular topic.
Okay, thanks a lot, typical Singaporean. So I think let's cover one, because since you are talking about you are speaking, right? So let's just go through, I think, the question that you just asked here. I think skip this one first. In terms of the ex-US, if not China, what geographical ETF is promising? So I think I'll just give my comment first, right? I think for, if we rank the countries by market cap, right? I think US is number one with about, let's say, 60% percentage or 60% allocations. Actually, the rest, right, the big one are Europe, which Europe, we all know that they are all have a big problem now, right? So Europe, I won't go there. Then the next one will be, I think, Japan. Japan, I think, is like, the problem is like, they have demographic shrinking and so on, right? And there are quite a number of value companies there. But when it comes to innovations, I think also something that's like more like a question mark. I wouldn't say all of their companies are bad, right? So Japan, I will also rule out. And then I think the rest, right, will be, you see, like maybe North America companies will be like Canada, maybe some South America companies would like, Brazil, and so on, right? South America. Then I think those two, I think, will be quite close to US. If US is doing well, they will do well as well. So higher correlations, right? The one that I would say, right, if you say excluding China, right, I think the promising one is either India or Southeast Asia. But the problem with India and Southeast Asia is always like, okay, how come these countries here, although they are promising in terms of demographic growth, right? How come they are, most of them still stuck with the, like the third world countries, say, developing forever and very hard to get out from the trap, the third country, developing country trap. So that's the one that I think a bit, like I don't see a sign that any countries within Southeast Asia will break up, basically. So that's why I don't plan to have allocations in these countries. But if we really focus on the demographic, I think the Southeast Asia is the one to focus on. So I think that's my take on when commenting on the geographical ETF. So I'm not sure you have any viewpoint on this, or you want to comment anything on this?
Yeah, because as someone that actually does business in this region, the entire issue is the capital class are not protected. I mean, not protected as an investment class. And I mean, okay, it's like once you start making a large business, you start dealing with the government, and the government will want a slice of the pie. Whether or not it's above board or below board. And this is true for every country within this region to a certain extent. There are some countries that are better, there are some countries that are worse. And unfortunately, those countries that are better tend to be smaller, those countries that are worse tend to be larger. So that is my experience with the governments in this region, and they seem to be quite stable. This is accepted culture in those countries. That's why when you talk about geographic ETF, all those public, I mean, for example, let's say Indonesia, let's say you were to buy their stock market ETF, I would not say it's very exciting, because it's the same situation. I mean, once they start making profits, the government wants a cut. Then you don't know what they will do to make it such that they have a cut. That's my experience with it, whether you're private or public also.
Yeah. I think that's also explained why they don't reinvest back to the companies that much into innovations, right? For example, right, if you say they can't make it so big that the country don't go and disturb them, right? They could still be a profitable companies. For example, right, you say I'm running this business, I get like, let's say 20% return on my, let's say my market cap, for example. They can just do the dividend payout and then basically just distribute whatever they earn, right? Let's say they pay out the let's say 80% of the gains, and then they basically just reinvest very minimally. And over, let's say 10, 20 years, right, you could, as an investor, you could still earn 15 to 20%, which is a very high returns for stock investment, right? But the company itself, it won't grow big because they won't retain the money to do innovation and just progress along the class, become like a big companies, like innovative companies, right? Basically, they don't have incentive, because if they reinvest back and then they make it big, right? Then now the gain actually not belong to the shareholders. It will subject to a higher tax or whatever, and the government will come and disturb them, right? I think that's also the reason why companies in this region tend to like stay small and very hard to break out from the trap now. So that's what my view is. That's why when I say if they are having this kind of attributes, I won't say they are all bad investment. That's not my view. It's just that if my focus is more to invest in companies that really like interested to build some moat, right? And then to make it big, right? For example, even in Asia, we still have companies like TSMC, where they really reinvest back to their company a lot, and they can make it big, right? They even surpass Intel. So I think if I target this company, and if if it happens that they are mostly in US or in China, right, then I would just focus more into those countries. I wouldn't say that I must have a diversified investment across different countries, right? I don't think that is really needed, right?
Yeah, I mean, what you said earlier, the one about, this is exactly what happens. And the thing is that all these small companies actually have a moat. A lot of these countries, like Indonesia, for example, is very protectionist. You want to import stuff inside, you got tariffs across a wide range of items. So they want to protect the domestic market, domestic producers. So you are, in exchange for this protection, you're expected to pay up. I guess that's how it works. So they have, 280 million, 300 million people, probably more if you count all those uncounted people. So maybe the domestic market is good enough for them. That seems to be the case lah. So, and then the whole of Southeast Asia, Thailand, Vietnam. I think Thailand and Vietnam is probably better than Indonesia, but Indonesia is by way the strongest country that could possibly emerge if they wanted to, but they don't want to. That's the issue.
Yeah, lots of issues. Okay, another question from you. Which of the 10 billion cap and above companies will drown in the next 2 years? There's some discussion on this topic in the chat group, right? So I don't have a view, so I'll just pass. But let's say if you have any view, I'm happy to hear like what are the reasonings, right? But for me, I think the first one to look for is their cash burn. So for example, companies like Palantir, although they are more, dilutive, right? Because of the stock-based compensations, but they will be fine, right? They don't have to tap into the capital markets, right? But which are the ones that actually have a cash burning? I haven't looked into the data, but you mentioned Lucid, right? Yeah.
Yeah, I look at Lucid. I look at Lucid because it's an automotive, and I know that automotive, especially the last chain, you are borrowing a lot. You have to borrow a lot. You have to somehow finance your car for how many years before you see a single dime. And Lucid has essentially, I saw their balance sheet. They have 3.5 billion in cash because they raised quite a bit when they were high cap. They are a bit lower cap. And their actual long-term debt in terms of loans and stuff is about 2 billion. And they are burning about 500 million per quarter. So you have 3.5 billion in cash. And I looked at the rest of their assets. The rest of their assets are all like inventory or stuff like that they have very little accounts receivable because they sell very little. So they basically cannot convert their PPE into cash. They can't convert their inventory into cash. They have to somehow rather pay. They have a long-term debt of 2.5 billion and they only have 3.5 billion. So within 1 year, they are actually going to be negative in terms of cash versus debt. And that 1 year is counting from June 2022. Now I know that, so I went to research a bit. In August, like last month, they filed 8 billion in shelf registration, meaning that they are expecting to do further fundraising within the next couple of months of $8 billion worth. That's probably how they are viewing it. So if they're going to do that, which is high likelihood, then the dilution will be quite big because 8 billion upon a $10 billion company, it's going to be a big dilution. So the shareholders better expect that dilution to come. Yeah, Lucid is going to drown, in my opinion.
Do you plan to buy some put on that or just short the companies?
That is a consideration. Rivian is stronger position. Rivian is a much stronger position because they actually do have a backlog. Sorry, yeah. Okay, I got to go off. Sorry.
All right. When talk about shorting, have to go already. Don't make too many enemies. No, just joking. Okay. I think I don't have more to talk about on these topics. So let's skip. I'll combine these two questions. Thought on investing in semis. Now, given that the ongoing or looming recession continue to DCA and the questions on recessions coming, I need to ask, right, what is this semis or semis that we're It's like a
semiconductor.
Huh? Sorry?
Semiconductor. Yeah, I think it's semiconductor. There's two questions on semiconductors. I think it's still not answered. So this is one or two.
Okay. So I'll combine three lah. Okay. So this question on semiconductor, I don't know this short form, sorry, and one that asks about outlook on semiconductor, right? So okay, semiconductor first. I think it's quite bad. I think don't want to sugarcoat it. If you look at the PC or personal computers market, and you look at smartphone markets, they are all down, and they are down quite a lot. If you look at the some of the tweeters that I follows, right? I think whether it's on TSMC, which is mostly on the logic boards, right? I think also there are rumors or even news already, some are already confirmed, right, that they will lower the price and then they will cut down the orders and so on. And we see that Nvidia's already have this problem of inventory issues. So I think all this, right, is not like just plain speculations, because there are things that you can watch out for to understand where are they now. For example, you can just look at the inventory level and know that they have demands issue. I think this is true for logic. And this is also true for memory, semicon, for example, like Micron. So if you look at Micron, also, I think it's quite bad. Like now we're talking about DDR5 will become more mainstream, right? After the MD5 board that just came out, they only can use DDR5, and the production will continue to ramp up just because of the needs, right, of this board, right? Why is it that all this price is projected to drop? Is because there's still if you compare the cost of productions versus the current price, right? The current price is still higher, so they will continue to churn up their production and lowering the cost until it is not profit making anymore, right? So what it means is that if you look at their financial statements in the recent 1 or 2 quarters, right, that earnings, right, was based on the pricing based on the past 2 quarters. And now we all know that the price is dropping and then orders has been cut and so on, right? So if you just project this forward, right, you can see that their earnings, although let's take Micron or you take TSMC earnings as an example, right, we probably already just hit their peak earnings, So moving forward, you'll see that all sorts of negative earnings will flow into their financial statements. This one we should expect is coming. That's why the share price will drop first, right? So I would say that the outlook itself is quite bad. We are already entering like a winter for semicon sectors. How bad it is, this one is really depends on which company that we're talking about. I think TSMC will be better than the rest because their order book, there's still like there's still backlog in terms of their order books. So they are kind of a shield a little bit. But when it comes to pricing, I don't think they will have much leverage to keep on increasing price nonstop like what they did in the past 1 to 2 years, right? So I think let's be more, be realistic on what's going to happen over the next 1 to 2 years. I think over the next 1 year will be quite bad. At least you will see that the earnings, revenue all will be bad. So it is what it is. But usually, the good thing is usually the share price will bottom before the financial bottom because the financial is always lag behind the stock price movement, right? So that's the positive things. Yeah. So I think, just to wrap up these things is that whether we talk about like semicon, which what I just described, right, is going to be bad, and the recession topics is that also will be bad. Because we already see that, layoff already started, and then with the increased interest rate, you see home prices already came down. Quite a number of different prices, right? For example, like the freight prices, meaning the shipping costs, all this also came down. You just triangulate all these data points, right? I think I can say with quite a high confidence that 2023 will be a recession year. Or you can say that now it's already recession. It's just that 2023 is even worse, right? So I think this will happen. So we all just need to be realistic on that, on the state of the economies, right? The market just dropped by 25% since 1 year ago. It's not for like no reason. This is not random things, It's because based on all the data points is that the economy is heading towards a worse situation. And we don't see this, like, let's say, just back 6 or 9 months ago, we don't see all this, right? Now it happens. That's why if you want to react also, unless you can say that 6 months back, you already see all these bad things happening, then of course you should sell 6 months ago, right? It's that all this bad news doesn't come at once, right? They came in every month. There's new data that pointing towards like a economy that is getting worse and worse. So it is what it is. The question is, how do we position it? Because at current state, we also don't know, like, we know it will be bad. We don't know how bad it's going to get, right? It could be very, very bad, meaning that for those who are trading, you should actually sell now, right? And just buy back 6 months later, right? I mean, it could be the case, or it's actually not so bad and market could already bottom last week, right? Or this one, nobody knows, okay? So I don't know, like for those who like just with high confidence to say market has bottom or market will not bottom, I don't know. I'm not that kind of people. So I can describe what's the state now, and I can describe what will be the state over the next 3 months based on the data points that we are reading, right? But all these usually are not so helpful when it comes to like positioning your portfolio, because what I just said, like things that I know other people also know, so not so helpful one. You want to know stuff that most other people don't know in order to help with your short-term trade, right? Yeah. So I think that's the comment on these two questions. I don't know, anyone want to add on these two, give your viewpoint or not? I'll just pause a couple of seconds here. Okay, let's wrap up. I think we are almost 2 hours already. Do you think the Fed was too slow in raising the interest rate and hence playing the catch-up game now? The answer is yes. Actually, they admit this, so we don't have to judge their report card, right? They say that with hindsight, they should actually cut down their QE sooner and also raising rate sooner. They admitted it. It's just that at the point when they have made their decisions, right? I think it's just that to be fair to them, they also cannot see like 6 months ahead, right? So with hindsight, of course, the answer is yes. But based on the data that they have at that point, right? Whether they should or should not, I will not comment too much. I think this one is a bit more like qualitative, because for those who always think that inflation will bite us, right? Of course, these people will say they should actually hike the interest rate sooner, even with the data point at that time. But there's also people who actually at that time still doubt whether we will have an inflation, because QE is something that is not new, right? It's already QE 1, 2, 3 throughout, I think, since 2009 until 2015, right? And yet we don't see that much of inflation, right? It's just that I don't know, this round because of the COVID, and sometimes it's also because of the fiscal stimulus that the government has done, right? I think these two are very different compared to the QA 1, 2, 3 periods, right? So there are things that are different. And I also don't know, like, how these two things that are different, how come the inflation bite us so strong this round, right? I think this is also something that I didn't expect now. So I think there are also economists that don't expect this, right? And these are the group of economists that will say, actually, inflation won't bite us so soon one. So it's okay to like just continue the QE longer and keep the interest rate low for longer. Also, I would say that's wrong, right? I think that's also fair, right? So I think basically everyone are blind basically, and they're just shooting blindly, right? And this round is that, okay, those who say inflation will be much higher than expected, right? This round, these are the group of economists or speculators that turn out to be right now. But this same group of people are actually wrong from 2010 to 2015 because inflation stayed low for so long, right? So for those who are interested with all this debate, right, I think I will encourage you to read Howard Marks' memo. I think his viewpoint is basically to say that all these are just, don't bother to make all these predictions because we all don't know, like we are all blind. So why bother, right? So I think that's the thing. How will this aggressive rate hike affect the national debt? Well, this one a bit hard because the rate hike, right, actually they will increase the borrowing cost, right? So the higher borrowing cost means that the government will need to raise more debt just to serve their interest costs. So from that angle, just that specific point, right, I think the national debt will increase. Then the second thing is that there are a lot more other things that will affect the national debt, right? Basically how the government is running, but whether they will increase their deficit or not. This one, I have no idea because there are a lot of things happening at the same time, right? But what I will watch out for is whether the government will do crazy things like what UK has done. For example, if government say, because the inflation problem is too big of a problem, they need to subsidize the energy costs, and then they go and cut the tax and so on. If they do that kind of things, of course, the national debt will just skyrocket, right? So I think for US, it's relatively still okay. But I don't think they can cut their spending enough to just offset their interest costs. So I mean, given everything unchanged, right? Just looking at the hiking interest rate, right? I think national debt will be higher, and hence the government borrowing costs will also be higher. And I think the government really have to do a painful decisions. I think they have to either raise their tax, or they have to cut their spending in order to bring their fiscal into a more balanced state. So this is just, I mean, this is the right thing to do. It's just that very unpopular, and this will get everyone to be in a more painful state, right? So I think this is also tough, very unpopular, and hence very hard for the policymakers to implement. Okay, hi Boon team, maybe we can use the Q&A poll to get inputs from audience at times. Q&A poll. What kind of inputs from the audience? I don't know. I a bit like I don't understand this question. Like this suggestion also, I don't understand. Like we can use the Q&A means the Telegram poll, right, to get inputs, right? What kind of inputs also? Okay, maybe it's talking about what kind of question or what kind of topic to talk about. I think I'll take that as a suggestion. I think that's a good idea. Maybe we can do that in the future. Yep. Thanks a lot for the suggestion. Yeah, this one I've already covered. Okay, I think this week, right, actually I prepared a little bit. I think for this one I have time to went through this, and then when it comes to topic that I want to cover, actually I want to cover the UK one. I think that one is quite interesting. But you know, this is like nerd talking stuff. I think not many people like to talk all this in details. So I'll see, let's say anyone is interested to get on this topic in more details, right, that talk about like UK pension and so on, right? I think we can have a separate session. And then I think there's this picture to show that, you know, like UK 40-year government bond yield just increased from 0.5% to 4.8%, right? Actually, this is big thing, you know, because if you look at how much is the price, right, the price drop, right, it's actually 75%. So imagine we're talking about government bond, the government bond of a UK, you know, that can drop by 75%. I think this is almost like, you know, I don't think even like Tether, you know, like or crypto, I think some of the stable crypto also didn't drop as much, right? So you see, this is like a big things that are happening in UK markets. And of course, for the AI Day, thanks a lot to YCX for the discussion. I think that's really in-depth discussions on Tesla. And of course, this is interesting topic. We can, of course, go into more details now. So basically, that's it for this week. Thanks a lot for like contributors, especially, you know, like Boonsong, YCX, typical Singaporeans, and to everyone who contribute to the questions. I think that really helped us to come up with an interesting discussion. Okay, I will stop here to release you all for the lunch. Thanks a lot for joining. In terms of the upload, I will upload maybe a bit late because I will go out in the afternoon. Thanks a lot for everyone. Thanks a lot. See you guys in the chat group and next week. Okay, thank you. Bye-bye.